Hello market participants, welcome to the channel. So if you are someone who thinks that the IT sector will be a wealth creator or a sector that will outperform in this year, you probably need to think again. So in this video we'll try to understand why I think the IT sector will be an underperformer or a sector that will not create wealth in this current year. So with that, let's get into the video. Now before we understand why IT sector will underperform, we need to understand the basic structure of the IT sector. So we have large cap IT companies, then we have mid cap IT companies, then we have small cap companies. So in today's video, we'll only cover the large cap and the mid cap IT companies. Now another part in the IT sector is the ER&D companies, that is engineering research and development companies. Companies like Tata Elxsi, KPIT Tech, Cyient, LTTS and all that. Right. So in the large cap IT company, there are companies such as Infosys, TCS, HCL Tech, Wipro, all that. So these are very large market cap. They have slow to moderate growth due to large size, but they have the higher dividend payout, right? And then they are diversified across various different sectors. Let's say BFSI, healthcare, all that. Now, second part comes the mid cap IT companies, companies that have a market cap of less than 1 lakh crore. So this includes companies like Emphasis, Coforge, Persistent Systems, all that. Now, mid cap IT companies, they usually have higher growth due to the smaller base, plus they have higher, plus the order book grows at a higher pace, and overall growth is high. Now, these companies sometimes have a diversific concentration in some sector. For example, Coforge has a specialization of concentration in the BFSI sector, whereas Persistent System has concentration in the healthcare and high tech system, I think. Yeah, in the high tech system, right? So the next part, and then there's product companies. Product companies are basically companies SaaS that provide SaaS, software as a service. This includes companies like um, Intellect Design Arena, then Radiant Travel Technologies, then Nucleus Software, Oracle Financial Services, all that. So let's understand the characteristics of these companies. Right? First is that large cap IT companies, slow growth, higher dividend payout, high diversification. Mid cap IT companies, um, high growth, higher order book, comparatively low payout ratio, margins in the mid teens to early teens, and then concentration. Now, the ER&D companies, that is engineering research development, a special characteristic of these companies is that these companies have very high operating leverage and deleverage cycles. That is what operating leverage basically is. That whenever sales grows, there's margin. Whenever sales growth at a higher pace, there is margin expansion. Whenever sales, there is a drawdown in sales, the margins contract. So if you want me to explain why these companies are going through a downturn, then just let me know in the comments below, and I'll make a separate video on these companies like KPIT, Tata Elxsi, LTTS, and all that. Right. So moving ahead, and then comes the product companies or the SaaS companies. So these companies have very high operating leverage and deleverage. That is because these companies have reinvestment cycles. So in case of RateGain, if you look at it, like I'll just show it to you. Yeah, just a second. Yeah. So if you look at RateGain, it had a period of high growth from 2020 to 2023, like as you can see here. So yeah, sales growth was very good, but now in the last 2 quarters, what has happened that the sales growth has come down, like from let's say 70s, 80s, to it has come down to like almost single digit growth, right? So this is one of the reason. Plus it is going through a reinvestment cycle. What is reinvestment cycle? Basically company reinvests all the profits into developing another product. So if you want another separate video on this on the product companies as well, let me know down in the comments below, and I'll create another video on that. Right. So moving ahead, one of the main reasons why the IT sector will not be an outperformer or will underperform is because of the valuations. Now let's just look at the valuations of the IT index as a whole. So just yeah. So what I have here is the P ratio of 5 years of IT sector, and if you can see that the median P of the IT index is 28 around. So 28 is the mean of the P, and whenever P drops below, we see mean reversion, and whenever P goes above the mean, we see mean reversion. Like this is the post-COVID rebound rally, where P ratio went almost 36 times. After 36 times, so we saw sharp correction almost 28 times, which is again mean reversion. Now next, here in January 2022 or December, the Nifty IT peaked out, cyclical peak out, and the P ratio went to almost 38, 39 times. So what conclusion we can draw from this is that whenever the P of Nifty IT goes above 35, we can say that there is a cyclical peak formation, or it has become too expensive, right? So even today, if you can see that the P ratio went to almost 36 times, due to which we have seen a sharp correction, right? I'll just show it to you with an example in the technicals. Yeah, so if you can see in January 2022 we saw a correction of almost 31%, right? And after that, what happened? We saw time-based correction for almost how many days? 413, I'm not sure, but for about 15 months. Yeah, and also what we saw today is that it has declined almost how much? 20% from its peak. Yeah, so just thumb rule is that whenever the P of Nifty IT goes above 35, we can say that it's expensive. Now, why I say it's expensive? Because it has factored in the growth, and if growth fails to deliver, then we can see sharp correction, as we have seen in recent times. Now this brings me to my second point, which is a slowing growth. So if you look at Infosys, you see the revenue growth has slowed down to single digits. Like for the past 5-6 quarters, there has been single digit revenue growth. Now there are two main reasons. First is because deal wins have been softer, and second reason is that there was a really high base. Like after the COVID rally, IT sector grew exponentially, which led to a higher base, and and P ratio expanded, right? And when growth fails to deliver after P expansion, what happens? We see a P contraction. So this is exactly what is the case, that after 20s, like early 20s revenue growth, the growth slowed down to mid-teens, and finally now in single digits. Similar case can be seen in TCS, where there was like mid-teens growth, mid-teens to late teens growth, which then followed by single digit growth, and it has been soft ever since. Now, another reason why the market is pushing down the price of the IT index is because of the revenue guidance. Now let's look at the revenue guidance of this is Infosys, I think. Yeah. So even Infosys has revised its revenue growth guidance to 4.5 to 5% in constant currency terms. And if you look at HCL, even HCL is given to growth guidance of 4 to 5%. So based on this, we can see that revenue is not coming back anytime soon, at least for this year. Okay. Now also another thing that I've seen is that the deals have been softer and for a shorter duration, right? So this is one of the reason why IT sector has seen a sharp correction, right? So now that we have seen how the IT index peaks out, we'll also look at some of its constituents and how the valuations peaked out and what are the current valuations. Right now, I think I just have a list of stocks and I'll just read it out. That Wipro in its pre-COVID used to trade at 14 to 15 times earnings. TCS used to trade at 17 to 18 times earnings. Infosys used to trade at 16 to 17 times earnings, and the IT index was at 28 times, I think. Right now, now what we have seen is that Wipro at the peak traded at 32 times. TCS traded at 40 times price to earning, and Infosys traded at 30 times to its earnings, right? So this is also what track to keep. Like if you just want to keep track of the broader index, that is a good way, but you can also keep track of individual companies. Now moving on to second part of the second point is that the US policy uncertainty to a really unstable situation in the US and geopolitical relations. Now, what has happening in the companies like even Accenture and some IT companies in the US is that most companies they are not willing to spend as much money, and they are holding back their investments till they get some clarity. Right now, as we know that most of the revenue of IT companies comes from either North America, Asia, or Europe. right? So automobiles are facing automobile ER&D companies like KPIT we just saw, they are facing a slowdown because of automobile slowdown in Europe. But now coming back to the large cap IT companies, what we are seeing is that due to slowdown in the US, the big players there are not spending as much, and as a result, the discretionary IT spending has reduced. Due to which, the companies in India which do outsourcing for those companies, they are also seeing softer revenue growth. Now, next is also next part is uncertainty in the US. Yeah, the big players holding and reducing the spending, and next is the AI and the generative AI. Now, to talk about the generative AI on this stage, it's still pretty early, I think, because we're seeing disruptions like every month or so. We're seeing new AI models, LLM models, and all that. Now, I personally don't understand so much of it because I'm not from a tech background, but what I understand is that this AI, all the AI theme is still in a very early stage, and it is difficult to find out whether it will be an offset or be actual growth driver. Many companies are investing heavily in it, but only time will tell whether this is an offset or whether it can actually be a growth driver for these companies, right? So this is what I was thinking. Now, this concludes the fundamental part of the video. Now, with stage analysis, let's understand it on a technical basis. So here we have the chart of Nifty IT on a weekly basis. Yep. So now what we can, so using stage analysis, we'll understand what is happening. So just a second. Oh, what's that? Yeah. So what we saw after Nifty, after COVID, was that we saw the post COVID rebound rally. So this is, you can say that this is the stage one right here. Why? Because there was cheap, but there was also no growth. So this is the stage two. Why? Because here we saw that PE multiples expanded rapidly, stocks weren't cheap anymore, and full blown growth. Now, what we saw here was that margins were at peak, growth was at peak, and most of the future growth was also factored in. So, this marks our stage 3, and this is where the market topped out. Because why? The PE ratio crossed 35, growth slowed down, a cyclical slowdown, not an actual slowdown, but a cyclical slowdown. And this is right here. This right here is stage 4, right? Correction or consolidation, what I want to call it. Now the market consolidated for, let's say, like this is June 2022 and April 2023. So the market, so the Nifty IT consolidated for almost, let's say, 12 to 15 months. Now this again marks the base formation, or you can say stage 1. Now again here we can see stage 2. Why? Multiples expanded, growth was high, um, future growth also factored in, and now we can see that this is another cyclical top for the IT index, which marks the stage 3. Why? Multiples at peak, margins are at peak for the ER&D businesses, and plus we can see growth slowdown. And what we are seeing here is a classic case of stage 4, right? Now the what I think will happen, as per technicals, is that the market might come down, that the IT index might come down a bit, then it might start consolidating, wait for the revenues to catch up, wait for the growth to catch up, and then it might lead to another bull run, or what you want to see, like another uptrend, right? So what I am going to be doing in this time for the IT sector is just to stay on the sidelines. Now, just a disclaimer that I am invested in some of the IT businesses like Tata Elxsi, KPIT from very low levels, and I might have position or might have slowed down. You should take your own independent decisions, consult your financial advisor, whatever. But just a standard disclaimer that what I am going to be doing is just hold my current IT positions. I won't build any new positions because my view in these companies is like a 5 year plus views, because the sectors that this caters to is an evergreen sector. Like auto sector won't fail unless the economy, like there's something underlying problem in the economy, right? So we'll just cover that into another video, the ER&D companies. But what I think is I'm going to be on the sidelines because there might be some top down opportunities, sorry, bottoms up opportunities in some IT companies, but it is still too early to see whether it might be an actual turnaround or just a bounce back rally. So there's a few companies that I think Nugent Software, there is still some operating leverage in these companies. Intellect Design Arena is a company to stay away from because it is going through a reassessment cycle for the short term. and plus Radiant Technologies. Like if you have a plus 3+ year view, then you can maybe look into it. But again, we don't know how long the correction will last. But if we talk about the broader market, I think the broader market it is at fairly valued. I don't know much about Zomato and Geo Financial being added, but no, let's stay on the topic. What I will do is that I will stay on the sideline, track these companies, and if I find any bottoms up opportunities and stocks, I will invest. Not my whole, but let's say if I have a capital of 10 lakhs, then maybe I'll invest 10%, that is 1 lakh, into a company. And then as I see that the fundamentals are improving, the growth is back in, margins are like all that, then I'll maybe pyramid into it, or I might start averaging into it. Right. So this was all for today's video. Hope you all liked it, found it information, and if you found it informative, drop a like, and let me know down in the comments below which sector or what type of videos you want to see next. Thank you.